Hi, my name is Yasha and I help young men with investments. So today we are going to analyze Aflac Incorporated with the stock ticker AFL. And for that, as always, we are going to use this little Canva presentation that I have right now here. Now, this company, Aflac, is actually quite interesting. I found it completely randomly. And then I was thinking, okay, let's take a look at it together. Let's see how good it is. So then we can see whether we should also buy it and add it to our own portfolio or not, okay? Now, before we start, why should you even listen to me? So, as you know, my name is Yasha and I help young men with investments. When you have more trust for me, I invite you to click the first link in the description where I will teach you absolutely everything about this. Now, let's begin with the actual analysis, okay? Now, whenever you are a young man and you have a limited budget or you just are starting on the stock market, your biggest fear is that you will lose money because you will pick bad stocks, okay? That's why I'm here. I will teach you how to analyze stocks as a complete beginner. No crazy calculations, no hyper intelligent IQ, no nothing, just pure logic and some knowledge and you should be fine, okay? So, whenever you analyze stocks as a complete beginner, you should generally care about the following 6 things, okay? You should care about the chart, profit, debt, money on the bank account, value, and price. By the way, I absolutely love the logo of this Aflac. Absolutely crazy. This duck is on top. Okay, so here we have some quick facts about Aflac. So it's an insurance company that was founded in 1955 and it works in United States and Japan. And here is immediately the first thing that you should pay attention to. So as you know, this company was founded in 1955. And as a rule of thumb, the older the company is, the safer and probably better investment it is for beginners, okay? Because when you think about it, this company has been on the market for around 70 years. And within those 70 years, you know how many crises happened. They had dot-com bubble, they had Cold War, they had then 2008 crisis, they had Black Friday, they had coronavirus, they had that little stock market crash that happened maybe 2 weeks ago, you know, and they survived all of that because they are still here, right? But when you compare this, for example, with some startup company that was founded maybe last year, that startup company is much riskier investment because they haven't been through so many crises as Aflac, for example, okay? So as a rule of thumb, the older the company is, the better and safer investment it is, okay? I recommend you that whenever you start investing in the stock market, that you find those old companies, you know, that were founded maybe between 1950, 60, 70, you know, you find such companies that are also maybe famous, and then you invest in them and you learn with them, okay? And then you might upgrade this to newer company, you might upgrade to startups, IPOs and similar things, okay? But okay, I'm sorry, I'm talking way too much. I really just want you to understand that the older the company is, the better. My rule is preferably company between 1950 and 1970. Those are the golden ones. Okay, now let's proceed with the chart. So for chart, we have an instruction that it has to grow for all 10 years, okay? Because when we analyze the last 10 years, we have a better perspective of the development of the company, okay? How they are managing it, how they are profitable, and similar things, okay? But now you might be asking yourself, okay, here we have a chart, what should we do with it? You should do the following. First, we are going to draw a little exponentially growing line, kinda like that. And now we are going to compare the actual stock price chart, which is the orange line here, with this black line that grows exponentially, and preferably they should follow each other, because if they follow each other, that means that the company is profitable, they are making more and more value, you know, they are making more and more profit, their stock is growing, their value is increasing, they are just better, they are expanding, they are growing. Okay, this is what we want to see. We want to see growing companies because at some point when we invest in them, they will grow and then we sell and then we make the money. Okay, we are in the stock market for the money. That's it, it's that simple. So now what do we have here? As you can see, the graph was following this black line quite well. Obviously then Corona happened, so the stock crashed a bit and then it started to grow massively again. Okay, so this chart is absolutely perfect. Okay, this is what we want to see. We want to see that exponential growth because this is just the best for the business and for us. Okay, now we come to the profit, and for profit we also have an instruction that it has to be in plus and it has to grow as well through all of the years. Okay, now here is the very same story as with the chart. We will draw a little exponential line, kinda like that, and now we are going to compare this profit line with that black line, and preferably again we should have an exponential growth. Okay, now what do we have? So here we have a little down and then up a bit and then down and then up, and now slowly up. So you can see, even though we had quite a bit of ups and downs, the trend is going towards the top. You know, it's growing kinda slowly. You know, this is what we want. Okay, we want to see a growth because that will just bring us more profit, more money. We want the money, don't forget that. Okay, so now is the profit chart good? Yes, it is, because it is in plus and it grows as well through the years. Good job. Okay, now we come to the debt, and instruction tells us that debt has to be low and preferably it should also decrease through the years. Okay, now what do we have here? Here we have exactly the opposite. Here we have the growing debt and then falling debt a bit. Okay, now let's think logically. Is this good for the company or bad for the company? Now let's think from your perspective. The more debt you have, are you happier? Probably not, because more debt means more stress, because you need to make more money to repay that debt, and then you maybe also take another debt to cover that first debt, and then you are just constantly in this cycle. You are stressed, and because you are stressed and worried, your emotions start to kick in. You know, you are starting to overthink things and then you do some stupid decisions. That's how people go broke and that's how they stay poor forever. Okay, because they do stupid emotional decisions. Now with the companies is the same. The more debt they have, the more stressful they are, because the more money they need to make. Okay, generally more debt means bad things. Okay, it's that simple. Obviously we have two types of debt: the good debt and the bad debt. So I teach both of that in the first link, so if you are interested, go check it out. Okay, but now, do we have decreasing debt? No, we don't. Okay, because the debt is growing, so debt is something that we don't like here. Okay, as I told you, it just creates stressful environment. Now we come to the money, and here we literally take a look at the money on their literal bank account. Okay, just like you have, for example, 500 euros, 600 euros that you got from your grandparents, from your parents as well, uncle, aunts, and so on and so on. Here we have the same money on the bank account. Okay, in Wells Fargo, in Bank of America, in Chase. I don't care which bank they use, we care about the money that they have on the bank account. Now, why is it important that they have more money than the costs? Because whenever something unexpected happens, they have that money right now here on the bank account to cover some unexpected events. Okay, don't forget, they are an insurance company. So let's take a look what would happen if some person would die. Okay, when a person dies, they have to pay that. So instead of selling assets that they have, they can just take the money from here. Or let's say that there is some earthquake in Japan and they have to cover the cost of the houses. What do? Okay, they're seeing we have $4 billion on our bank account, so we will just use that money to quickly cover those costs so that we don't have to sell anything whatsoever. Okay, you know what I'm saying? More money on your bank account is generally better for you. Also, if you would be a millionaire, you would be much relaxed. But if you have 500 euros on your bank account, you are stressed. You need to pay maybe the bills, you need to pay the food, you need to pay for expensive dates, you need to buy the condoms so that you can fuck the women. You know what I'm saying? Constantly something on your head, okay? But when you have the money, it's much easier, it's much calmer to do things, you know, same with the companies. So, do they have more money rather than costs? Wait, do they have more money than the costs? Yes, they do. As you can see, they have a positive bank account balance, which means they have more money than the costs. They have plus $4 billion on their bank account, which is absolutely amazing. Okay, now we come to the value, and obviously we are as good investors, we don't want to invest in stocks that are overvalued. Okay, we want undervalued stocks. And how do we measure valuation? By two things. First one is called P/E ratio, and the second one is called intrinsic value. Now, as a complete beginner, those two terms might sound a bit confusing. Don't worry, we will now go as easy as possible through it, okay? P/E ratio is used to determine if company is undervalued in comparison to their competitors and the whole stock market as well, okay? And preferably, if you want to have undervalued stock, P/E ratio should be lower than 15, because 15 is the average P/E ratio of the whole stock market. So if we want to have undervalued stocks, we have to have P/E below 15, okay? Now, P/E ratio of Aflac is 11, which is below 15. Wait, it's below 15. So based on P/E ratio, the company is undervalued. You can find P/E ratio literally everywhere in Google. For example, we have it right now here, okay, on this website called Ticker Terminal. Now, intrinsic value also tells you, intrinsic value is the second measurement that we use to measure valuation. So intrinsic value actually tells you the price that the company should have per share, okay? And then we compare that price with the actual share price, okay? Let's take a look at the example. So intrinsic value of Aflac tells us that one stock of Aflac should cost $81, okay? But the actual price per share is $104. So what do we have here? Here we have an overvalued stock. How do we know that? Because intrinsic value should be higher than the current price if we want to have undervalued stock, okay? Now, what do we have here? The price that they should have per share is $80, but the current price is $100. So the current price is by $20 higher than it should have been. Therefore, the stock is overvalued. You know what I'm saying? It's that simple. It's that simple. So yeah. Now, generally, we have one undervalued valuation and one overvalued valuation. Now, what is the summary? You want to be as harsh as possible, so we will mark this stock as overvalued stock. And now we come to the price, and as a rule of thumb, we want to have stocks that have price per share lower than $150 or euros, because we don't want to buy expensive stocks. Expensive stocks cost more, we lose more money to buy one stock. We want to have cheap stocks so that we can buy more of them, and then when more of those stocks grow, the more profit we have. It's that simple, okay? Now the current price of Aflac is $104, which is below 150, so we are good to go, okay? This is my personal limit. You can of course change it the way you want it, but for me, stocks are expensive when they are over 150 euros. And now we come to the final evaluation, where we are just going to summarize everything that we found out about Aflac Incorporated, okay? Now, does the chart grow exponentially? Yes, it does. If you don't believe me, go watch the whole video again. So it grows. Does the profit grow? Yes, it does as well. Wait. Does the debt decrease through the years? No, it doesn't. Do they have money on the bank account? Yes, they do. They have $4 billion. Is the stock overvalued or undervalued? It is overvalued. And is the price below $150? Yes, it is. So should you buy or sell? In my opinion, you should buy if intrinsic value should be higher than the current share price. Okay, I personally would buy this stock if intrinsic value would be a bit higher. Okay, because otherwise stock is absolutely amazing. Look, the chart is growing, the profit is growing, debt is also growing. But when you compare the debt here with the whole money that they have, it's actually below 50% what we want to see. Okay, now here you can see my detailed evaluation of this company, and you can see that everything is growing. Okay, gross profit is growing, margins are growing, net income is growing. They are reinvesting more and more money into the company, which is what we want to see. They are profitable. Look, they have 20% profit. Their debt is low, it's below 50%, what we want to see. It's amazing. It's an amazing company. It really is an amazing company. Just it is a bit overvalued based on our calculation. Okay, so therefore I recommend you to put it on a watch list if you want to make some good money with it. I hope that we can buy it when it goes down a bit and then just sell it for the higher price, because so far what I've seen, the company is growing, they are reinvesting the money. It's an amazing thing to see. It's an amazing company, just a bit overvalued. Now, if you want to know more about stock market, if you want to get more knowledge, click the first link in the description. Otherwise, click subscribe and join me on my journey to become a millionaire with investments. Do the hard work and see you on top of the world.